Good morning. I'm Allison Maffett, and I'm an attorney with Cogent Law Group. And today I will be speaking about the money transmitter licensing decision framework. So the main thing we're going to be talking about today, or I'm going to be talking about today, is a founder's framework for determining licensing obligations in fintech and crypto. We like to focus on or help guide clients and companies to see what comes next and try to understand their legal and regulatory obligations that as challenging as this may sound, that are known and unknown going into the licensing process. So the purpose of this framework is just working through, do you receive money for transmission or issued stored value? Do any exemptions clearly apply? And what's your roadmap if licensing is required? So every single business that touches fiat or crypto has one of these three outcomes. No license needed, an exemption applies, or MTL licensing is required. That sounds so simple and rudimentary, but it is the fundamental decision that a company needs to make while moving forward with the licensing process or not moving forward with it. And we like to work with companies early in the process so that we can understand the flow of funds, so that we can help guide a company to accomplish their goals in a manner that meets the regulatory burden or the needs of the state and federal regulatory bodies. So what is a money transmitter license? I call them MTLs, so I'll probably call it an MTL most of this talk because an MTL is it's a lot easier than money transmitter license, but it's a state level authorization required for businesses transmitting money or monetary value. And that includes fund transfers, currency exchange, in some cases crypto is included, payment processing and stored value issuance. So it's required in 49 states and all the territories. The one exemption is Montana, and then it is subject to dual regulation. State licensing and federal FinCEN registration. FinCEN is the Financial Crimes Enforcement Network. It is the federal rules that determine whether or not a company needs to be registered as what's called an MSB, a money services business. And that is it's a determination that every single company needs to make. We will see a lot of situations where somebody or a company does not need an MTL, but they are an MSB. So they need to understand the federal regulations, how they apply to the company, and then also the states and the states individually. So an MTL involves complex applications, net worth requirements, surety bonds, the complex applications. There's obviously the basic forms, basic company information, everything, name, EIN, address, the control people, those are the owners, the ultimate beneficial owner, the UBO, also the executives. And this is an important thing to understand within your own company, is obviously a CEO, CFO, CTO, Chief Compliance Officer, Chief Operating Officer. Those are pretty straightforward. But then if you've got a chief marketing officer, do they have control over the direction of the company? Do they have control over decisions? If they do, they need to be a part of the application. If they don't, it needs to be clear that they don't. And then if the state has questions, that's got to be answered clearly. So one of the steps that has to start, like a company must start with defining a business model. That sounds really simple. You're saying I'm getting funds from point A to point B. What could be confusing about that? Well, it's how the money moves. Does it convert? Do you have on-ramps? Or what type of rails are you using? And all of these items are incredibly important. So before analyzing the triggers of an MTL or MSB requirements, you gotta map the business itself. The core product flows in plain language. You've got to be able to explain it to your next door neighbor, somebody who has no idea what money transmission is, no idea how the process works, you have to be able to explain it. And these are things like consumer, merchant, B2B business, cross-border payments, crypto. You've got to just be able to turn what you're working on into the simplest of language and identify who touches or controls customer funds at each step. Is it a bank that is controlling the funds? Is it a bank that is sending the funds, receiving the funds? Is it a sponsor? Is it a payment processor, a platform, or a third-party service provider? All of these pieces will determine whether or not a company needs a license. And there are times when you start with a bank, a sponsor, a processor, a platform, and or a third-party service provider, and slowly shift away as a company becomes more licensed in more states and becomes more independent, self-sufficient. That's definitely a very viable business model. So a couple of the things that really need to be defined: who is the consumer? You've got to map out the core product flows for the consumer-facing products and identify the fund touch points at each step. So what we mean by that is you've got to be able to say, like, my customer is somebody who wants to send funds to, using Chris's example, send funds to a farmer in West Africa. Is it the distributor? Is it the ship? Like, that doesn't matter as much. You just have to understand what the starting point and the end point, so define the customer. The merchant, who controls the funds in a merchant-facing flows, from the payment initiation to the settlement. What'd you say? Wait, go back. Can you go back? Thank you. So, thanks. You've just got to understand where the funds are touching, the B2B, trace the movement across business-to-business transactions and intermediate roles. Got to be able to just clearly articulate how the funds move, where they move, who touches them, and in turn, who has control. So cross-border, this adds another layer. If you are sending funds internationally, there are regulatory touch points. Got to be very careful with your what's called AML policy, or anti-money laundering, know your customer. So if you're adding cross-border payments, that adds another layer. Definitely doable, and states sometimes treat it as something they need to monitor, sometimes they don't. So that's why you have to do a full analysis of all the states and territories. And then crypto, that's another piece. Is a virtual currency treated like fiat? Is a stable coin treated differently than Bitcoin? Are there nuances to how a state treats a two-party transaction? And two-party is, I'm sending money directly to the person sitting next to me. Or is there a nuance with a three-party transaction where I send it to Coinbase, who sends it to the other person? These are the elements that have to really be understood with each flow of funds and each type of transaction. And so those distinctions are, you're good, yeah. Those distinctions are what really drive the analysis. So up next, it's defining your business model. This might sound repetitive and kind of silly. Of course you know what your business model is. But the challenges of these nuances and understanding how to present them to a regulator, that's what is so important. So a clear understanding of your operational mechanics is paramount for compliance. And before we can even start the evaluation of the compliance needs, you've got to have a complete understanding of your current business model, potential future models, and these core product flows. I cannot explain how important they are, and I can't explain how, I will continue to try to always explain how complicated they can be. So what becomes really vital is this money moving because of a smart contract? Who has control of the smart contract? Does that mean that the funds are still in control of the bank or the wallet or or the company hosting the wallet? Or is it who coded the smart contract? These are the pieces that need to be understood, and this is from the regulatory side, this is from the insurance side. Because what happens if your smart contract gets hacked? What happens if somehow a wallet gets drained? Who's responsible? That's what the state cares about. The state cares that their residents are protected. So this fits in with identify the fund control points. Pinpoint every entity that touches or controls customer funds. Is it a bank, sponsor, processor, your own platform, a third-party service provider? You've got to understand fully. I put $20 US into my bank account sends it to where? Do they send it to the company's bank account? Do they send it to, does it get converted to USDC? All of these, and how does that happen if it does? So all of these are pretty important. Next slide. Thank you. So this steps into the core licensing trigger analysis, the key test. And to be clear, it says you or your agents. An agent can mean a lot of different things, but if you have local branches or you have a company working for you, providing the services, that can be an agent. So the key test is if you receive funds from one person and transmit or make them available to another person or location, or you hold the funds for later transmission. So map out the activity against current definitions of money transmission. So each state has different definitions, even though there is what's called the Money Transmission Modernization Act, which states are starting to adopt pieces of that, and it's starting to bring in the uniform language. Does not mean it's interpreted the same way. So there's still ambiguity in varied responses. So that's why we use some general terms, but we are saying that you have to look at each state individually. So general terms, the sale, issue, or issuance of payment, instruments, stored value, or receiving money for transmission. Depending on the state, that means domestic or international will trigger different reviews by the state. So what's a payment instrument? Sale, issuance, are you selling or issuing checks, drafts, money orders, or similar payment instruments? That doesn't always apply in a crypto space, but it can, because it, again, depends on what the ultimate goal is, who the customers are, and how the flow is actually structured. And stored value. So this is another complicated one with crypto. Do you issue or physical or electronic stored value that can be redeemed for money or goods and services? How does a state view crypto? Any type of virtual currency. There is one state that views only stable coins as something that needs to be regulated the same way as fiat. To that particular state, it doesn't matter if it's Bitcoin, Ethereum, a meme coin, that goes in one bucket, but if it's a stable coin, it's treated like a fiat. And then the final transmission. Are you receiving money for domestic or international transmission to a different location or person? These sound like straightforward questions. You should know your product, no big deal. But again, it goes to the nuance of how the money flows. Could you go to the next slide, please? Thank you. Okay, so going back to a little more detail about FinCEN. So that's as I said, the Financial Crimes Enforcement Network and the MSB process. This is, like I said, you can be an MSB without needing MTLs. So this sets the fundamental rules that pretty much everybody has to follow. Determine whether your activity makes you a money service business under FinCEN. So this applies regardless of state licensing. And so the obligations, you have to register with FinCEN. That It's a pretty simple process. You provide information, bank account information, EIN, person in charge. Like it's a pretty straightforward process, and that's mandatory. You get a number, you renew it every couple of years. You list the states that you transact in or will be transacting in soon. If you're going through the application process, you might put the 10 states you applied to in this round, and then you wait to put the next 40 states. So you just be as upfront and clear about the information as possible, and it can be updated easily and in real time. In my opinion, the most important piece and the piece that's looked at the most closely in this space is the AML BSA program. So that's the anti-money laundering. You've got to implement a comprehensive anti-money laundering and Bank Secrecy Act compliance program. This is a document that not only you have to follow it. And both federal and state regulators will look to see if you are following it. This is done through a variety of, basically any organization or any law enforcement organization can turn to this and say, hey, here's your AML policy, which your compliance officer signed off on, which your board approved, whatever it is, and they will say, did you do this step, this step, this step? And they will check. They will go into every single transaction in a period and review it. As a consumer, I appreciate it. As it's a slow process, it's an important process, and so you've got to have a good AML policy. It needs to be audited regularly. The audits need to be reviewed. The policies need to be updated. Just in the longer than I would like to admit, time that I've been in this industry, the changes that we see in AML policies to keep up with technology, to keep up with how people trying to game the system, the bad actors, AML policies have to stay vigilant. So that's one of the big things. Know your customer, so KYC. You've got to verify your identity or the customer's identity to prevent illicit activities. That's one that when I say technology, bad actors, they move quickly. I mean, think about how AI can replicate a voice, make a video. Well, as an AML KYC officer, or the program, you've got to be able to verify somebody's identity. So if you're using a live video, how do you know it's live? How do you know it's not AI? There are so many steps that need to be taken that 5 years ago weren't on our radar. So you've got to stay up to date, push for changes, and stay vigilant. So OFAC screening, that's the Office of Foreign Assets Control. So this is a pretty straightforward screening against a sanctions list. And a sanctions list can be individuals, it can be countries. There are certain countries that the US does not want you working with. They're business decisions how you navigate that, but has to be a part of the policies. Record keeping. This is where I tell clients that in the fintech space, you have such an advantage. The companies need to maintain detailed records of transactions and customer information, which includes the KYC, which includes the additional information that, like any transaction over even sometimes as low as $3,000 needs additional information. I strongly push for my clients to show their work, if you will. You've got the fintech, you've got the technology, it's there. It's more, you're stepping into something with tip-top technology, use it, and show that you have more systems in place that you can access, that you can study, than a traditional bank, because they have decades of trying to catch up. You're coming in 2026 and you say, okay, here's my product, here's my information, and it's already there. So that's why I think there's a huge advantage for the fintech space when it comes to record keeping. And then the travel rule compliance. This applies to certain transfers requiring the sender and/or receiver information to be passed along. This gets a little complicated in the fintech space because it goes back to that flow of funds. Depends where the money really, who's transferring it, who's gathering the information, and to be really candid, everybody should be keeping the records so that if anybody asks questions, they have it. Even if it's 50-50, that company's responsibility, that company's, just always keep the records, always try to protect yourself. And then SAR, so suspicious activity reports and currency transaction reports. These are very important. The SARs especially, they just need to be filed. It's a pretty tight deadline. If you miss the deadline, still file it because it's important to get that on record. That's another one where it's a little bit complicated depending on the flow of funds, who's responsible for filing it. There is no harm in filing if you know or you're not totally sure if your partner has filed it, you still file it. Just take the extra steps. It doesn't hurt, and it makes it a lot simpler when you're going through something like a Title 31 review, which is when the IRS looks at every single transaction and asks about your AML, KYC, your record keeping, and goes into real detail. So the next is the state layer. Do you need an MTL? This goes back to, we were talking about states generally require licensing before transmitting money to or from their residents. Multi-state operations create a patchwork. 50 state coverage often means 40 plus licenses. Sometimes it means 20 plus. And a handful of exemptions and a few no license state. And there's clearly no single license that lets you operate nationally. So this patchwork takes time and diligence, and it really is a business decision do you go for all of them at once? Do you build slowly? That's a decision that can be, that's a business decision. That's the best way I can put it. Next one. So some of the high-level exemptions: agent of the payee, bank exemption sponsorship, closed-loop stored value, gift cards, pure payment processing, card acquiring. I'm going to focus in on the agent of the payee and the closed-loop stored value. Agent of the payee, funds collected on behalf of a merchant, and the payment is deemed final upon receipt by the agent of the payee, the company that is taking in the payment and then paying out the payee. So once the payor pays the company, the payment is deemed final. So that means this is a pretty traditional business model. In the fintech space, it gets interesting, for lack of a better word, because are you bringing in the money in fiat? Are you converting it to crypto? Are you sending it out in crypto? Are you sending it out in fiat? And it goes, again, back to who has control, how do you keep the money safe? For the most part, states have pretty similar agent of the payee exemptions, and that means it's a written record. It's very clear that the agent of the payee is sitting in that role. It also means that the payment piece, that's one of the big ones. And I think, I should know the exact number, but more than half of the states have agent of the payee exemptions actually in their money transmission law. Some states have established gray areas. I wouldn't call them a full exemption, but a gray area because it's historical court cases. I would not feel comfortable with those because, these are not recent cases. So we highly recommend, if you're not sure, you think one is not required, then you take the route of going to sending what's called a no action letter request. And so you're requesting a state confirm that you do not need a license. The other one I want to talk a little bit about is closed loop stored value gift cards. I think everybody here knows what a gift card is. You can get one at, I don't know, I got coffee this morning at Dunkin' Donuts. So you can get a Dunkin' Donut gift card. It's pretty straightforward. It's $10, can only be spent at Dunkin' Donuts. That's the same concept as a closed loop stored value, because if you have a product that can only be spent at Capital Tech University, it can be a closed loop. Can't take it to University of Maryland, just here. Is it something that can be, like, that's gonna be closed loop. So I think you guys can probably think of some fintech closed loop networks that might make, there might be an argument that you would have an exemption under money transmission. With that being said, a lot of these are undefined. So you have to go through the full analysis of, is this a closed loop stored value in this state and this state? And so you just have to keep working through the analysis with each state individually. It's, especially in fintech, not, or especially with crypto or some type of token, it's not as straightforward. Next slide, please. So, high-risk fact patterns for founders. Consumer wallets and pooled funds. So, especially where you have the technology to delineate which funds belong to which customer, this is called, so an FBO account is called for the benefit of. This is used by banks, wallets. You can say, you can have a ledger, and your internal ledger determines who owns what. And think about traditional banking. Does the bank have all of our funds sitting in the bank? Physical bank? No, they have ledgers. And they move the money around on the ledgers sometimes without moving physical money. That can apply for wallets. And how do you protect yourself as a founder? How do you ensure that the licensure is appropriate? And this goes back to states might look at virtual currency differently than they look at fiat. Banks have different charters. Banks have different rules, different regulations. Is a state going to say, well, you're holding crypto like a bank would hold fiat, and we're not going to regulate you? Some of them might. Some of them might not. So these are the other items we have to look at. Peer-to-peer transfers, bill pay, remittance products, especially cross-border payments and on-off ramps. Those are the real sticking points that we work through with clients. And using bill pay as an example, are you paying the bill in USDC? Or is it sitting in USDC and it goes and gets paid out in a dollar? And how does that transaction occur? How does it go from a stable coin to a US dollar? That's the real crux of when you do or do not need a license. So next slide. So with the for the benefit of the FBO accounts, big questions you have to fully understand is the high level, we're going to use fiat in this example, but the sponsor bank holds the pooled customer funds on behalf of the fintech. Using an FBO account does not remove the licensing risk. It does shift the analysis though, because the big question is who controls the money? Who controls the movement of the funds? Does the fintech direct the fund transfers, or does the fintech tell the bank what the customer requested and then the bank directs the funds? That might not sound like a difference. It's a huge difference when it comes to the regulatory. Who's basically pressing the button to transfer the funds? That's what the key is here. And who markets the product? So that shifts it a little bit too. So is the fintech presenting itself as the custodian of the funds, or who's responsible for the fund security to the customers, or is the fintech very clear, like your funds are sitting in this bank, they are the custodian. and that can be just how you present the product. It can be in the terms of service. It's a lot of nuance that needs to be as clear as possible. And then just simplifying, who is the money transmitter in substance? Is the FBO structure enough to protect the entity, to keep them, to have in this case, the bank be the one actually transmitting the funds, or is it the fintech? So is it directly transmitting the funds, indirectly, or peering to? How do you clarify this? Make sure that the states understand it, and in turn, either need a license or not need a license. Okay, next slide. So this is simplifying the decision tree, work through what the flow of funds is. So if you start with, assume you always need a license, and then work backwards. So is there an exempt activity? That's not completely straightforward, but that might apply to some states, and you work through that analysis. And then the other big item which you're working through in parallel with is it exempt activity. Does your business move or hold the funds? Do you have control? Can your business determine what does or does not happen to those funds? That's the oversimplification of what you're looking at. So touching customer funds, are you touching or controlling the funds, you being the company directly or via an FBO? And if the answer is no, licensing may be reduced. Everything is always may. Sorry, that's just being a lawyer. And then if you do touch or control funds, the next step is an exempt activity. Again, you have to look state by state, and if it's a gray area, ask the state, talk to the state. If the answer is no, then you go to step 3. So assume that the MTLs are required, begin building the licensing program and the compliance program. I will say the compliance program you should be building no matter what, because if you are an MSB, you have to follow these rules. Okay, next one. Okay, if an MTL is needed, what's your corporate readiness? So you've got to have very clear entity structure, governance, and you've got to have a business plan. You've got to have very clear flow of funds. You've got to be able to tell a regulator who understands the industry but has never heard of your company, they just care about their residents being protected and their funds being safe. You've got to be able to explain everything to them in detail when you apply. So it's got to be on paper and clear. A lot of all states have minimum net worths. The amounts range. Most of them sit between 100 to, the high end is 500,000. New York requires 2 million, so there's some outliers. And those have to be in permissible, like, you have to have a permissible investment policy, so it can't be speculative. And the funds have to sit there. It's a simple way to prove that the company has the net worth. And the states will look at different assets a little bit differently, so you have to pay attention to each state. Audited financials, it's on there twice, but I guess that's how important it is now. You need financials. Some states have caveats. If you're a startup, you can have unaudited financials for a year or two, but you will need audited financials within the first 4 months, I think it's of each year. It might be 3 months, but you do need audited financials. So develop a good relationship with an auditor, especially in the fintech space. If you're using crypto virtual currency, it's vital. Surety bonds. So there are not a lot of insurance companies that will work with crypto and fintechs. So you've got to develop good relationships with the surety bond companies, the providers. You've Usually it's about 2 to 3%, depending on the company, that you're gonna pay in surety bonds. So if you're doing all 50 states, this is hundreds of thousands of dollars. And that's an annual cost that has to go into consideration. For a startup, they're gonna be lower figures. As the company grows, transaction volumes grow. That's when the surety bonds continue to rise. Next slide. All right, this is the fun stuff. Application and operational build. So from the legal perspective, I think there are some advantages of going through the licensing process that you might not think about if you're growing a company without these very formal steps. But something like registering your company as a foreign business in each state, if you're operating in that state, you should register. Well, a lot of companies don't think about that. So that's an additional step that's really important. And just to clarify, in the US, if you're a Maryland business and you are going to operate in Virginia and you register, you're registering as a foreign business in Virginia. That's just our verbiage, a little bit silly. But with that, you need registered agents. And going back to, we talked about having a business plan, making sure the compliance policies are clear. Each owner or control person, so key personnel, has to have background checks, credit checks, resumes. They have to go through the process of verifying who they are and that they are, in a sense, trustworthy to be in this position. NMLS is the platform that you submit 47 of the applications. So it's helpful, all of the information, such as the business plan, compliance policies, key personnel, all of their information is in one place. And then you add the additional information that states request. So that's just a helpful system, and they're constantly working to improve it. So it's a frustrating but appreciated platform. So that's just what you need to get the application process rolling. From the operational build side, transaction monitoring. So this is where we're talking about with the AML, KYC, and the record keeping and how a company has to act as an MSB, that you have to have these processes in place and then actually follow them. And that ties into KYC onboarding. And I'm going to go back to, states are always wanting to protect their residents. So you have to have a clear process for complaints, how you handle them. You have to have email address, working phone number. We've had states call the phone numbers and make sure that it's actually a human being that will answer the phone. Not necessarily live, but you have to call back. So they do check these things. Daily reconciliation. A state's not necessarily going to check that when you're applying. They have the ability to audit the companies that have licenses. They have the ability to go through, they can do it individually or multi-state review. So you need to have the proper reconciliation in place. Segregation of funds, that's paramount. The operational funds, the customer funds, they cannot touch each other. You can't, I think we can all think of one particular very large example that put gave the fintech industry a black eye, and they didn't have their accounting in order. There was no, it was a mess. So segregation of funds is absolutely paramount. These last two items are growing in importance. You have to have a plan, disaster recovery plan. So you have to have the business continuity to, again, protect the residents using these products. And so usually companies have not used their business continuity plan when they're applying, hopefully. But you have to have this down on paper so that if something happens, the state is assured that the residents will be okay. And then the board level oversight, this is not across the board in every state, but like New York, for example, they're going to want an independent board member because, I sound like a broken record, they want to protect their residents. So if you have a board that's just comprised of the CTO, CFO, and CEO, are they going to have that independent view and voice that the state is looking for to call out a compliance risk, to call out a risk management? And frankly, there are companies that can do that, and they're very good at that. There are others that want to keep moving forward with their product and not pause to reevaluate. So that's why some states really push for a board that has at least one independent voice. Okay, next slide. Oh, the fun stuff. Timelines, costs, and go-to-market strategy. So licensing will take 3 to 12 months if it goes smoothly. The multi-state coverage will take at least 2 years. And significant capital, bonds, professional services, the alternatives are limited state launch or partnering with an already licensed MTL and white labeling a product, or narrowing the product scope to fit a clear exemption in as many states as possible. So we just put these in some pretty big buckets. Limited state approach, focus on the states that are going to be most important, or focus on the easiest ones to get. Those are two pretty different approaches, but both very valid. Partner with a licensed MTL, or try to purchase a company that has some MTLs. Those are routes that companies are willing to take, especially if they're getting the product off the ground and then so they use that while they are applying for licenses. So they can operate with the partner, and then as they get their licenses, they shift over to their own working through their own licenses. And same idea with a white label model, but then narrowing the product scope, that's another option, where start with something where you don't need a license, start the company, get some funds in, start growing while you're applying for a license. So those are pretty general buckets, but they're, I think, pretty productive. Next slide. All right, so some adjacent legal considerations. These, I think everybody in this room has heard quite a bit, but sort of securities and token classification, just understand what the product is, understand the federal regulations. AML KYC programs, I can't repeat enough how important those are. So many law enforcement agencies can point to your AML KYC and say, well, you didn't follow this. And each company is responsible for it. There's no gray area with that. Consumer data privacy laws, really important. The idea that you have somebody's social security, you have their driver's license, you have all of this information because of the AML KYC process. It has to be protected, and states care a lot about that. So those are pretty important. IP protection, that's an interesting area in this space because you get a variety of approaches to IP. Is it open source? Is it something that somebody's guarding very closely? Those are all items that need to be thought about. And then, smart contract enforceability. Okay, regular audits on smart contracts, and that's just the tech side. But then conduct a legal review of the smart contract designs to ensure that they're valid and enforceable across different jurisdictions, and how they're being approached with going back to who has control, who's responsible. These are all, under the law, a person has to be responsible, or a company has to be responsible. So keep all of that in mind. And next slide. So this is the law firm side coming out, when to engage counsel and regulators. any borderline or novel structure, payments, stored value, bank partners, they warrant a formal legal analysis, and a written memo supporting the licensing or exemption position, I guess, and/or engage state regulators as quickly as possible. Talk to them, they want to work with you. It's risk mitigation, faster licensing, and then stronger relationships, because if you're coming to them with some type of, I'll say this, there are a lot of times that we will go to a state to discuss a teeny tiny nuance where we're pretty sure we know the answer, but we need them to formally respond because they haven't responded in a way to other questions before that break out that slight shift of nuance, and that could be how a liquidity pool is funded, when it's funded. Those can impact licensing. So it's all of the details that go into this. And then strategic compliance. Make sure your advice that you're getting from the industry, from the lawyers, from the regulators, aligns with your business growth and your objectives. So use that with the innovation instead of looking at that as something that's holding you back. All right, next slide. I think that might be. All right, key takeaways, next steps. Every founder lands on one of the three outcomes: no license needed, an exemption applies, or create an MTL roadmap. So complete a business model assessment. Really work through your flow of funds, work through your goals, identify applicable exemptions, and build that licensing and compliance roadmap. Even if you're not getting licensed, build your compliance roadmap. It is very important. So next slide, please. Where's that? Okay. I think that, yeah, keep going. I think that was the last one. Yeah, I think the one is just information. So yeah, do you guys have any questions about state licensing? I know, riveting subject. All right, well, thank you guys for surviving state licensing. And we've got about a 10-minute break before we get to hear from Chris.